before we get into it, I want to remind everybody to subscribe to our YouTube channel by clicking the button right below this video. We have content that's up there every week. We have live events almost every Sunday night as well, but lots of great free content. You don't want to miss any of it, so hit the subscribe button now and subscribe to our YouTube channel. So today, we have a lot of headwinds in the markets right now. But what do, and I'll go around and ask each of you, but what do you see as the biggest threat in the markets right now?
Oh, the biggest threat in the market? Well, I think what I'm noticing here, aside from all the events that we're seeing, crossing our TV screens here, what's happening geopolitically, is the fragility of the Treasury market, Roger. The issue that is happening is, the federal government just cannot bring themselves to rein in their spending, and the cost of carrying the debt now is starting to really penetrate the confidence of the Treasury market, and so it's going to be the largest line item in a couple of years now. The cost to carry just to pay the interest on the federal deficit, which now exceeds $33 trillion. The issue now is also facing where who's going to buy our bonds, even as rates are going higher. You can have inflation come down to 2 or 3%, but that doesn't necessarily mean Treasury yields are going to come down, because you're losing creditworthiness and confidence in the ability for the U.S. to pay its bills way down the road. And this is even though the dollar is stronger here, that's more of a flight to safety of the current environment. You risk the currency also starting to deteriorate over the long haul. We don't want to get in that situation where our Treasury has to continue to buy back its own paper when we're issuing debt. So you're basically just continuing to hemorrhage, the balance sheet long term for the U.S. And that is a big elephant in the room that still has time to be resolved if, in fact, we start taking legislative matters into our hands and start focusing on balancing spending and reducing spending and as long as the market perceives that, that's the golden path down the road, then we can see a restoration of confidence in these auctions. Until then, when it looks like there's the Congress, the White House, and the Treasury, Janet Yellen, who runs that, feels that there's no risk, and for some reason we've nothing to worry about, then that's a persistent problem. I think it's going to continue to weigh on these yields here. We're seeing that today. We're seeing where there normally would be a flight to safety in these geopolitical events, bond yields are still rising. That's not a good sign, okay, because it just tells you that the supply and demand for U.S. debt is starting to wane. And I think that's the greatest threat to the market, aside from all these other headwinds that we've talked about in recent weeks.
Yeah, he's right. There's a big liquidity gap in the bond market for much of 2022 and 2023. The Treasury was able to manipulate some of its processes to avoid issuing as much debt as the deficit required, and it's exhausted those procedures earlier this year. So it has to issue more debt than it was in the past. Also, the persistence of inflation is causing this problem because it's above the Fed's target. During the pandemic, the Fed and the banks were the major buyers of treasuries and took basically all the Treasury had to offer. But because of the persistence of inflation, the Fed can no longer buy those treasuries and push money into the economy and the markets. It has to stand by the side, and it's actually letting its portfolio of treasuries roll down, and it's not being a buyer going forward. The banks also are not buyers because the boost in interest rates over the last couple of years has given them a bunch of losses on their books. They have impaired capital, so they no longer can afford to buy the treasuries. So as Bryan said, there's this big glut of supply and little demand. So the yield on treasuries has to keep going up, even after the big jump over the summer and into this month. The yield on the longer term treasuries is still below money market yields. In a normal market, longer term yields are higher than the shorter term yields. So those longer term bond yields have to keep going up until they exceed the shorter term yields, and we get back to a more normal bond market. So that's going to be a big weight on the economy and on the stock market until we get this equilibrium set in the bond market.
So all Econ 101, supply and demand. What we learned back in college is holds true, that's for sure. But George, what do you think? And actually, I'm going to ask you, how much of these wars that are going on, how much is that weighing on the markets?
Well, it's obviously a crisis, challenge, and however, I started my investment life and my real study of economics in the 1970s when Jimmy Carter was incurring this great inflationary spike with huge interest rates and the first population crisis warnings, and it was an appalling period. And during that time, I drilled down and wrote Wealth and Poverty. From these crises, entrepreneurs drill down and find new opportunities. And the opportunity that I stressed during that era into the 1980s when I started writing a semiconductor newsletter was the silicon moment, that microchips were going to transform the entire world economy, and people who were investing in Intel and National Semiconductor in the 70s and 80s, and AMD even, and all these other applied materials, these people did fabulously well in the subsequent era. And today we're in a time of even greater transformation and even greater promise than the time of the Silicon Age. We're in a graphene moment, a new carbon age. And with the discovery and development and now mass production of single layers of carbon atoms that form sheets that are 200 times stronger than steel and 100 times stronger than aluminum per pound, that are 1,000-fold more conductive than copper, and which are the most heat transmissive materials that have ever been discovered, that they've addressed the heat crisis that now is afflicting the silicon economy. So I believe we're in a moment of transformation as profound as in the late 70s, early 80s, and that we're going to emerge from it with a completely new economy. Airplanes will be made of graphene before we're through, rather than aluminum. And the whole architecture of industry will be revolutionized during the next decade. And so that's what I'm focusing on. And there is turbulence and tempest around the world, but this is the time that new entrepreneurial opportunities beckon, and where it pays to really understand the physics and chemistry and finance of a new industrial age.